Nedbank posted a 13% rise in first half earnings per share. This boosted by strong growth in income from fees. Mike Brown, Chief Executive of Nedbank, is with us in studio to help us through the numbers. I suppose two things here. It looks pretty solid as the underlying performance, Mike. Your headline earnings per share, as we said, up by 13%, dividend 15% higher. Those are good numbers and compare favourably with ABSA. But bad debts, 23% up in this period. That is a cause of perhaps some concern to see the bad debt ratios now start rising again.
Alec, I think you've got it on the button. You know, I think 13% is a very solid earnings growth number in a difficult environment. We were very pleased to see we had 11% revenue growth and 8% cost growth, so that feeds into improvements in things like the efficiency ratio. But the credit loss ratio was the weak point in these results. That was at 1.31%. In our first quarter trading statement, it was at 1.22%. And we were hoping for an improvement on that, but that didn't happen.
Mike, I just want to read something from your results, and maybe you can put it into English for me because my brain can't work out these long sentences. Nedbank Retail generated headline earnings of 1.1 billion rand, down 11.7%, which were impacted by the early and comprehensive risk mitigating actions to address the concerning personal loan industry dynamics observed in 2012, particularly in relation to the high industry growth rates that mask the true underlying level of consumer financial distress. In other words, the South African consumer and the Nedbank customer is not quite as healthy as he and she should be.
Yeah, there are lots of words there, Lindsay. I think simplistically, you know, what we saw happening in the personal loans business in 2012 was loan books were simply growing too quickly, and that distorts many of the underlying credit metrics, particularly credit loss ratios. So we wanted to make sure that we stayed at the front end of the provisioning curve. So we changed most of our provisioning methodologies in our personal loans book, and over the last 12 months have added more than 500 million rand additional provisions, of which 300 million are in portfolio or the old general provisions. So there's no doubt that the consumer is under pressure. We've responded in what we think is an early response in raising our provisioning, and we've also slowed our loan growth. So our personal loans book to June is in fact 5% down on December on an annualized basis.
That's the real story, isn't it? Apart from the first strut write-off of 180 million, it's to do with personal loans. That's the core of your increase in bad debts.
Yeah, I think if you stand back, we've got good revenue growth, good expense control, bad debts higher than we expected, and that lives in personal loans and first strut.
Are you surprised to see that only ABSA so far has also reported that you haven't had a similar increase in their bad debt provisions? In fact, they were down quite considerably.
Yeah. So obviously, year-on-year increases always depends what's in your base from the prior period. And if I remember correctly, ABSA had quite a big catch-up in their prior period base around their home loans business and their commercial property portfolios.
Mike, just staying on this subject, we'll get to the good news in a moment, just staying on this subject, Abel's operational update came out yesterday, African banks that is, and they increased their loan portfolio, I think it was 19%, something like that. And I said to somebody, an analyst, I said, is that a 19% future problem? Are you going to sort of rein in your lending policy because of the numbers that you've just reported today? I mean, are you slightly cautious now towards the South African consumer?
So certainly on the personal loans front, we have been doing that already now for probably 12 months. Roughly at the moment, of every 100 loan applications we get on the personal loans front, we're approving somewhere between 15 and 20. And 2 years ago, that was around 30 to 35% were being approved. So we've significantly tightened our lending criteria, and as a result, you've seen our personal loans book, in fact, drop 5% since December.
So it's the personal side that we've been focusing on, but there was good loan growth and accelerating in other parts of your portfolio.
That's right. We saw very pleasing loan growth in our MFC business, or the vehicle finance business. That was up over 10%. We saw good growth in our card business, and also some very strong growth in our investment banking lending environment, where we started to see some of the renewable energy deals beginning to come through, and I think that's going to be an underpin to some reasonable loan growth there for the foreseeable future.
And good margins, Mike?
Yeah, I mean, certainly we think that the margins are good for the risks that we're taking in that environment, so we're very pleased with those transactions.
Mike, non-interest revenue, very impressive, 15.4%, and NIR to expenses ratio above your target of 85%. I think it was back in 2010 that PwC came out with a report on the South African banking industry saying that NIR would be incredibly important in the future due to shrinking interest margins. You've obviously focused on that. Maybe you could break down the NIR increase as to where it's coming from, fees, commissions, whatever.
Yeah, so I mean, we were certainly very pleased to show 15% NIR growth. If you look underneath that, there was very strong growth in what we would call commissions and fees, which is around 70% of NIR, and if I remember correctly, that was up 13 or 14%. Our trading revenues were only up 1%, but the first half of last year was a particularly high base. So again, that was slightly better than we expected, given the high base of the prior period. And then our insurance revenues were up 15%. We also benefited a little bit from fair value gains, which are certainly lower quality non-interest revenue and definitely harder to forecast as yield curves move around. So if you strip those out, the underlying NIR was up about 12.5%.
The big story that came out with ABSA last week was the special dividend they paid. Now, it's very hard for me to work out exactly what your comparable Tier 1 capital is, but the lowest number you give, because you give us three numbers, the lowest number is 11.8%. Their number that they quoted was 12.5%. Is that directly comparable?
So the directly comparable numbers would be what's now under Basel III called Set 1, or Common Equity Tier 1, and ours was 11.8%. Theirs, I only remember the number that they showed on a pro forma after declaring the special dividend, which would be 11.2% post that special dividend.
So are you going to declare a special dividend as well, given that you're so much higher than ABSA is?
No, so certainly what we're looking to do is to deploy that excess capital in growing our business, and we know that we have subscription rights that are available to us to purchase up to 20% of EcoBank or ETI. Mm-hmm. Those rights become available between November 13 and November 14. And what we're looking to do is build our capital levels so that we would be able to, if we choose to exercise those rights, pay for that out of organic capital. It will cost us about 0.6% of capital.
How much in rand terms? 0.6?
0.6 is probably about 5 billion rand, that sort of order of magnitude. It's quite dependent upon share price and exchange rate movements.
Sorry, Lindsay.
No, that's right. No, so I apologize. Just before we get onto your prospect statement, because I want to talk about your use of the terminology tougher and not tough, and more challenging and not challenging, suggesting that perhaps the future doesn't look particularly rosy for the South African economy. Just have a look at your clusters, as you call them. Nedbank Capital, we've just had Mohammed Nala in, and we have a lot of Nedbank Capital commentators, and they're always excellent, 16.9% up in their earnings, corporate up 23.7%, business banking not so good, retail we've spoken about, Nedbank Wealth. Maybe just give us a synopsis of all the different divisions, the highlights, and maybe some of the lowlights as well.
Yeah, so I think in the round, I mean, we're very pleased to be a universal bank with a diverse set of businesses. Our wholesale businesses did have a very strong first 6 months, as you correctly pointed out. Nedbank Capital growing strongly and a good trading performance, benefiting also from the renewable energy deals. Nedbank Corporate is a very powerful engine within the Nedbank Group. Its earnings were also up very strongly at a high level of return on equity and good performances both in corporate banking and commercial industrial property finance. And our wealth business was also up strongly, nearly 18%, which is a good growth rate. Clearly, the growth rates that were negative were retail and business banking. And in fact, coming back to what Alec said earlier, in retail, it's pretty much a story around us increasing the level of conservatism on personal loans provisioning. And business banking is essentially the first strut bad debt. If that hadn't happened, business banking would have been up about 9%.
It's interesting to look at your move into other parts of the continent in particular. You also signed the agreement with Bank of China, presumably to help them to work with you in Africa. But you've mentioned EcoBank, the Mozambican investment that you've made in this period. You have a pathway to control there. Just tell us a bit about that.
So what we've done is, this deal is still subject to regulatory approval, so we would hope that it would execute somewhere probably before the end of this year. But the transaction is for us to buy an initial 36% of a bank in Mozambique called Banco Unico, but there is a direct pathway to get us above 50%, so that will happen automatically if the first 36 goes through, probably I think about 2 years thereafter. And then there's a third leg to the transaction, which will see us owning somewhere between 51 and 70% of that business.
Mike, just the last minute and a half or so, Alec and I will you bring in Alec on this one as well. Just your prospect statement. You say the financial performance for the full year is set out below, and you go on about what your expectations are for advances, for all sorts of other things. But maybe you could just sort of contextualise that for us. What are your hopes, given what I've just said? I said previously, i.e. tougher, not tough economic environment, more challenging, not challenging, in reference to South Africa.
I suppose in many ways, from a macroeconomic perspective, volatility is the new normal. We're expecting GDP growth to be at around 2% this year, but every time Chairman Bernanke mentions that tapering word, we see enormous effects in financial markets in developed and emerging economies. So if we look forward to the end of the year to forecast, cognizant that it's very difficult to forecast in this volatility, we're still confident of achieving our full year growth targets for diluted headline earnings per share of CPI plus GDP plus 5. So that's the overall number that we still think we're going to hit in a difficult second half. I mean, clearly the risks would be what happens in the impairment line, which finished the first half higher than we expected, and we are expecting an improvement in the second half.
So between 13 and 14% headline earnings, depending on where you
depending
put
on where
GDP.
the other data.
A dividend, shareholders also look at around this kind of growth, 15%?
So our dividend cover in the first half was 2.18 times. Our dividend cover policy is between 175 and 225. So the middle of that would be 2 times cover. And what we're looking to do is slowly drop our dividend cover from 2.18 down to the center of that range, which for shareholders should be supportive of dividend growth, slightly ahead of earnings growth in a tough economic environment.
With the growth prospects that you have, and it's very interesting the way that you're approaching things, buying a small stake, getting to know your partners, then perhaps having the option to acquire control. Is that dividend cover of around 2, as you said, now sufficient?
Yeah, we certainly think that's absolutely fine. It enables us to support reasonable risk-weighted asset growth, so continue to grow our loan book and make sure that our shareholders are appropriately rewarded.
Mike, just a slightly bigger picture now with the tie-up with the Chinese operation and your Africa expansion and your aspirations for Africa and what's happened in the retail sector. What are your really big picture sort of strategic moves in the future? Do you say to yourself, well, the South African consumer can't possibly get much more beleaguered than he and she is now, so therefore let's continue rolling out our branch network and our retail offering and maybe catch up with a couple of the other banks that have maybe stolen a little bit of a march on you? Or do you look at Africa, do you look at the Nedbank Capital side, which worries me somewhat, because when someone says, yeah, we've been trading really well, I know that means that in the future there's going to be some sort of hiccup. Do you see where I'm going? What is the big sort of portfolio focus?
Yeah, I think if we look at the Nedbank franchise, we're still the smallest of the big 4 banks here in South Africa. It's the market we know best. So we're still extremely focused on improving our competitive positioning in the South African market. However, over the longer term, we know that the rest of Africa is growing faster than South Africa, that our South African clients are increasingly doing business on the rest of the African continent. So it's a balance between how we make sure that we position the business to be able to participate in that faster growing rest of Africa, but not losing focus on our domestic franchise. And the way that we've thought about that is in Central and West Africa, we've chosen a partnership approach with EcoBank or ETI. And in Southern and East Africa, that's where we're going to continue to build the Nedbank franchise.